there, Maverick Traders. This is Rob Reinhold. I will be flying solo today. Darren's not able to join us, but let's get into it. We had a great close to the September options expiration cycle, and I know the little down move last week really helped out a lot of our traders. So it's great to see we closed the books. We'll be getting payouts out to you on Tuesday as usual, but let's go over it real quick. So the big news last week was the CPI. The CPI report killed the rally. It killed it. So what we saw after the CPI report was we saw equities tumble, but we saw the dollar spiking higher. We saw the 10-year treasuries and all the treasuries spiking higher. And so we got this real ratcheting up of a rate hike. The Fed futures show an 80% chance of a 75 basis point hike, and there's now a 20% chance of a full 1% hike. This was not priced into the market whatsoever. And so again, the CPI report, let's go over it. It came in at 0.1% and the core at 0.6. And one of the most disappointing things about this number was that we talked about energy prices and food prices. These things have really contributed to a lot of the inflation. Here's the problem. This report was all about rents and a couple other things that aren't going to just go away. Rents, wages, things like that. And so it's a worry that the inflation is now more persistent. The market was thinking, oh, this is all about energy prices. Energy prices have come down substantially and inflation's not going away. And then on Wednesday, we got the PPI, the producer price index. It was hot as well. You can see a little bit higher on the core. Definitely the market has been anticipating that inflation will come down because of energy costs coming down, but energy costs came down and it's still here. Then we got a worse than expected retail sales report, and you can see that things are just not quite going the way the market priced out. So let's take a look at the performance last week. Let's take a look at the charts, and you're going to see that we are really below some key levels. So let's go through these. Everything was down anywhere between 4 and 5%. That's a big down week. We had a -2 on the week. We thought it was going to be a big down week, and sure enough, it was. You know, even oil and gold, everything got hit. This is just a sell-off across the board. If we take a look here at the S&P 500, you can see on Friday, we broke this last little support. But I do want to point out the candle we got on Friday. As you can see, there's a big gap down. We ran all the way down to the low, and then we actually came back at the end of the day. Look, this is a clear break of support, and I'm not trying to say that the support at 390 has not been broken. However, a lot of times you get what's called piercing. You get piercing of support levels, but it's not really a break. If we take a look all the way back in May, we can see that there was a candle here that was a pierce. We broke down below this support, but we recovered back above this very, very quickly. If we take a look at this candle over here, the one on Friday, it's a little bit different, but look, we had more buyers and sellers on Friday with the green candle. It just gapped down. If we can recover back above this early this week, I'm going to have to say that that 390 was pierced but not broken. If Monday and Tuesday are flat to down days, then 390 is broken, and that is new resistance. And we are definitely going to probably test some of these lows that we set down here in June. If we take a look at the NASDAQ, it looks even worse. The NASDAQ broke down on Thursday, but we also have this candle. Unless it has a big recovery Monday, Tuesday, this is clearly broken support. What was support will become resistance. And we think we're also going to be looking down to testing some of these lows that we set in June and July. The VIX had a spike, but you can see it just went right back down to the 26 area. We've been stuck in this 26 area for a very, very long time. And Friday pierced above it. We don't think we're going to get a real big bottom until we get this VIX above 30. Another reason why we are still fairly bearish on the markets is that we just haven't seen the capitulation. We haven't seen the panic. We haven't seen that yet. That's what typically marks market bottoms. So the VIX is telling us there's still probably a little bit to go. Now this week is also going to be a big week. Last week we had that big CPI report. This week we've got the FOMC meeting. I think the market is going to be pretty quiet on Monday and Tuesday. As you can see, there's absolutely no economic reports on Monday, Tuesday. It isn't until Wednesday where we get the FOMC meeting. And so the big question is, how big of a hike? The market is priced in 75 basis points. I don't think that that is going to be that big of a surprise. I think that's what we're going to get, 75 basis points. But I think the FOMC press conference that's held 30 minutes after the statement, I think that's where the fireworks are going to be. So I wouldn't be caught off guard with a movement off of the FOMC statement, because this is where Powell is going to speak and people are going to be asking him questions about futures interest rates. They could indicate that they're even more hawkish than the market thinks. If that's the case, this market is very highly likely to move lower. Other than the FOMC statement, you can see there's just not a lot on the docket this week as far as economic reports go. So this week, we are at a -2 and a -2 again. Once we have that 50-day moving average, once this actually starts to turn lower, then we'll go to a -3. But right now, we are moderately bearish at this point. Let's take a look at some of the sectors. All right, so last week, everything was down. The whole market got hit. But I really want to point out that this was like two different markets. Take a look at communication services, real estate, industrial, tech, materials. They're all down 6%. And then there's a whole other market, energy, consumer, financial, healthcare, utilities, that were down 2%, 3%. You can see where the pain is being felt are the interest rate sensitive sectors. And sure enough, real estate, industrials, technology, material, all of these are very, very sensitive. So let's take a look at utilities. Now, utilities had a pullback. There's no question about it. We actually really liked utilities last week. We had them at a +2, and now we've got to downgrade this to a 0. It's between the 20 and 50-day moving average. Whenever that happens, we immediately go to a neutral on these sectors. Next up, communication services. Looks absolutely terrible. This is by far the worst sector in the market right now. Nice little breakdown. We think this has got some more to go, so we are very bearish in communication services. Off to real estate. Real estate was hanging in there last week. We were at a 0 because it was between the moving averages, and you can see it did not stay there very long. We're now down here approaching some support levels. We could get a little bounce, but we are still very bearish on real estate. Moving over to industrials. Industrials, we had that bounce as well. Last week, we were again at a 0 because we were between the moving averages. We are now clearly broken down, and it looks like June lows are likely to be tested. So -2 on industrials. Healthcare. Healthcare is one of the ones that held in. So you can see here, we didn't break any new lows. Everything we just took a look at had broken these lows in September. And look at this. Healthcare is above those lows and holding in. I'm not saying this is a bullish sector. What I'm saying is this is relatively stronger than everything else. We're going to give this a 0. Moving on to financials. Financials, we also have to look at this and say, hey, another sector that did not break the September lows. Look, it doesn't look great. It's not wonderful, but compared to communication services, financials are actually looking like a decent place to go and hide. On to consumer. Consumer also holding the line, holding the September lows, and this is a decent candle on Friday. I just think that consumer is looking to hold in. As I said earlier, it's not bullish, it's just not the worst sector out there. And here we come into another sector that is interest rate sensitive. And so here we have a break of the September lows. It looks like we've got to go back down in here and test some June lows here on technology. So we are at a -2 on tech. Materials, another sector that could not hold the September lows. We've broken down. And this is, or even a red candle. This was one of the weaker sectors on Friday. One of the only sectors that didn't give a green candle. So -2 on materials. And then here we have energy. Energy held in really nicely. And look at this. A nice bounce on Wednesday, Thursday, and Friday. Friday had an up day. Energy looks decent here. It looks decent. I still am going to have it at a 0. But when I take a look at all the sectors, which one is on the top, I do have to say that energy is likely the best performer, even though we've got 5 sectors at a 0. You know, if we want to give energy a 0.5 plus, okay, that's fine. But look, energy's looking the best. Healthcare's looking decent. Consumer, financials, utilities are holding in there. This is a market of 2 groups of stocks. One that reacts positively to higher interest rates and one that reacts negatively. In tech, materials, industrials, real estate, comm services, with comm services being the worst, they are clearly bearish. So let's talk about some potential trades to put on in these markets. And again, we think that the markets are likely headed lower here. We've got utilities at a 0, and last week we actually talked about Southern Company as a trade. And you can see Southern was down negative 2.8%. We actually had the 75-80 diagonal call spread. Look, diagonal call spreads, this is why we like them. The trade actually went against us 2.8%. Because it was a diagonal call spread, it's a positive theta trade where if it goes sideways, it's actually just fine. It went down a little bit, so we have a tiny, very small loss on this, but we still have those October long calls that still look decent. We're at a good support level here on Southern Company. This week, we're going to take a look at First Energy. Now, the thing we like about First Energy here is look at Friday's candle. Friday's candle is actually a beautiful candle. And you can see we pulled back to that 20-day moving average. We found some support, and we actually closed up near the high. That's a really nice candle. Now, this is not a confirmed bull pullback yet. We need one more candle. So we do need some confirmation on this one. But if we can get a green candle on Monday, this will be a confirmation. And I'm looking to make a really, really wimpy trade, a 41-42 bull call spread. That's about the wimpiest trade you can make. But look, this is a utility company. So utilities, they just don't move quickly. So we're looking for a target up here of 42. Communication services. Last week we had T-Mobile. Now T-Mobile did not do well last week. It was down 3.9%. We were also diagonalized on this one, but down 3.9%. That is definitely a losing trade on this one. So this week, we've got Meta breaking down of this long, low base. So as you can see here on the chart, we've got this support right there at the 155, and we've held that for 3 months. We have a 3-month long low base, and we've broken clearly below that. When you have something that's based for this long, when you get a breakout, it's a big, big deal. So I know we had a lot of traders enter this one last week on Thursday. Great job. I think the trade still works because of this 3-month base. So I think you need to take a look at doing like a bear call spread, 145, 150, or you could look at doing a diagonal put spread. I do think, again, this thing has had the initial break. A lot of times they will come back up to the breakdown point. It would not surprise me at all if we got a bounce even all the way up to the 155 area. So I want to do something that will allow that to bounce up to where it won't put any pressure on me. If it bounces up to 152, 153, I want to be in a trade where I have the comfort to just kind of sit through that to where it doesn't force me to make a difficult decision. Because ultimately, it looks like this one is headed substantially lower. In healthcare last week, we had Pfizer as a short, and Pfizer was a great looking short. We talked about this bear rally all the way up to previous resistance, and you can see great trade. It was down 3.8% on Pfizer. We had the 46-48 bear call spread. So this is almost a max gainer on Pfizer. Not quite 3 cents, 46.03. If it was below 46, it'd be nice, but great trade on Pfizer. This week, Eli Lilly. Now, we've got healthcare to 0, so we want to take a look at some of these stocks in healthcare, say, hey, we want to be more sideways to bullish on these kind of sectors. And here we have one that is just flip-flopping around. We have a pretty hard level of support down here at 300. We've got some resistance up here right around 320. And we've got moving averages that are just flat. So we like this one on basically just a straight butterfly at 310. So again, 310 will be your middle. 320 is the upside call. 300 is the downside call. Do this for 1 week. I think it's going to be a decent trade here on LLY. Moving into industrials. Industrials, we are bearish industrials. Last week, we actually had a long on UPS, and this was probably going to go down as our worst trade of the year, down 11%. This was really from a FedEx miss of earnings. So FedEx pre-announced their earnings. FedEx stock was down about 25%, and UPS went right along with it. So this is why we trade with options. We had a 200, 205, 210 targeted butterfly. That is the wimpiest low risk trade. We position size it for max loss just for this reason, because we know that things like this can happen at the blink of an eye. And so we structure every trade to where if we do get this horrific news, which happened, that we only lose a very small percentage and we can just move on to the next one. So moving on to the next one. This week we've got Frontier Air. ULCC is the ticker symbol on this one. You can see here, we got this big jump. Now, this came off of JetBlue acquiring Spirit, and Frontier was in the running for Spirit Airlines. They didn't get it, and the market was very happy that Frontier Airlines did not buy Spirit. Here's the problem. You can see that happiness did not last all that long, and we've got this pattern here where we came down, we based for about a month, and look at this big break. And the candle on Friday said that there was no buyers coming in. The market had buyers coming in on Friday. This one doesn't. 11 is my target on this one. So the structure on this trade is going to be pretty simple. An 11-12 bear call spread. You're probably going to bring in about 65 cents. And that means you're going to have 35 cents at risk. Position size it for max loss. Go out 2 weeks. September 30th. Pretty simple trade on ULCC. Next up in financials, last week we had PayPal long, and PayPal actually had a decent week. At one point, it was actually up for the week a couple times. Look at Friday's candle. That's the kind of candle you do like to see. So PayPal was down, but remember, we did this on a diagonal call spread. So this one, this trade is actually at break even at this point. We think that 100 is still very, very likely here in the next week or two. Let's take a look at the next one, Citigroup, this week. And you can see Citigroup, we're also looking at sideways here in financials. Financials is one of the sectors holding in. And so we found this one, okay, it looks a little bit weaker than true neutral. It looks a little bit weaker, but we do have some pretty decent support here at 48 that is holding nicely. So we want to take a look at doing a butterfly on this. We're going to be slightly bearish to mirror our overall outlook in the markets. So we're looking at a 44, 47, 50 butterfly spread. If you do want to be a little bit more bearish on this, then I think you take a look at a diagonal put spread and you let that short option expire on this Friday, and then you reevaluate the trade when it's done. Moving on to consumer, last week we had Philip Morris as a sideways trade. We had a sideways trade, but we had it pegged at 100. So the trade was a 97, 100, 103 butterfly. And you can see we did not close in that range, so this one is going to be a max loss here on Philip Morris. Still looks decent as a sideways. It was only down 1.5% for the week, but we played this one slightly bullish. We needed to go up 1.5% this week. The next one, Foot Locker. This is a trade that one of our traders shared on our Wednesday live session, and I really liked it, so I jumped into this one with them. So nice high base here on Foot Locker. And look at the candles. The candles that we saw over the last 2 days are fantastic. Remember, the market struggled the last 2 days, and this stock went up. It didn't care. So we've got this 40 of some resistance. This is where we love our diagonal call spreads. Let's go out long the October 21st 35s, and then we'll just sell this week's 40s. And if it takes off and runs, guess what? It's a decent trade. We'll make a little bit of money. If it hangs out in this base, we're perfectly fine on a diagonal. That's going to be a profitable trade as well. And it isn't really down until down about 37 where we start to see a loss on this trade. So high base on FL, Foot Locker, looking decent. Moving on to technology, last week we played Shoals. Now we played Shoals the same way as we've been looking at a lot of trades this week. We saw this high base forming. We said, hey, let's do a diagonal where we sell the 28 and we buy the 25. Well, this stock went down 8.1%, and even for a diagonal call spread, that's a little bit too much for it to withhold. Definitely a losing trade, but you still have those 25 calls. We need to make a decision of what to do here because it is critically at support. If this support level holds, this could end up being a really nice trade. If it doesn't hold, you've got to bail on those calls, take the loss, and just move on to the next one. In technology, this week we've got Bumble. Nice bear rally. You can see that we came up right up into this resistance area. Went all the way back into June. We hit that, we tumbled down, and now we're breaking to new lows. So we've got a target on this one down here at 22. You could go even to 21, but I like to be a little bit less aggressive on my targets. So I'm looking at a 22-24 bear call spread. You're probably going to get in about $1.20, maybe $1.30 credit, which means you'll have about 70 cents of max risk on this trade. Just position size it for max loss, and you give it 2 weeks, and we'll see where it is. In materials, we had materials as one of those sectors that we're breaking down. Last week, we had Corteva. On the long side, same thing. We had a diagonal call spread. The stock went down 1.8% for the week, so that's about a break even on a diagonal call spread. That's why we love these diagonal call spreads, because you have some insulation. If the stock doesn't take off like you thought it was, and it just kind of hangs around, it's still going to be a profitable or break-even trade. This week in materials, we're looking at MT materials, looking at this as a little bit bearish, a little bit sideways. So we're really looking to just put in a butterfly here, a targeted butterfly with the target of 30. So this is slightly bearish. This is about 3% lower. So we're saying, hey, the stock probably goes about 3% lower. This one only has monthlies, so you've got to go all the way out to the Octobers. We like to take half of our profits when it reaches our target. So when this thing goes down to 30, we want to go ahead and scoop half the profits out of this trade and then leave the rest till expiration. Last sector is energy. Last week, we had a bullish call on Cheniere LNG, and we actually had the 165 targeted butterfly. And we hit this one really nicely here. So we had the 165, 175, 155 targeted butterfly, and I saw a lot of our traders close this out on Friday right when it was at 165. That's a really nice trade, up 3.7% for the week. This week, another sideways play. Let's take a look at XOM. And we just are going to be pretty much pure sideways here on this. We're just looking to make a 1 week trade here, the 87, 92, 97 targeted butterfly. It's going to cost you about $1.50. That means you've got $3.50 of gain and you've got $1.50 risk on both of your tails there. Well, that is it for our trades that we like to share with our traders. If you have any other trades you want to share with our traders, please log on to the Maverick Trading website. Go in. Let's get that discussion going. We always love to have traders sharing ideas. I know I grabbed a couple ideas from other traders on the back end of last week, and they turned out to be great trades, so it's always helpful. So in conclusion, we still have a downward market. We are now more bearish than bullish. We have talked about September being a very seasonally weak period. It's no surprise that we're getting more bearishness and bullishness in September. It typically happens. Remember, this week, FOMC meeting on Wednesday. I think the press conference is going to be the big moves, so I want to get too excited about any move off of the actual statement announcement. I think you need to wait until the press conference is over to really see how the market feels about the FOMC meeting. Everyone have a great weekend and be safe out there. Goodbye.